All right. I think the numbers have leveled off here in terms of new participants. So I want to welcome everyone to our webinar. Thank you very much for coming. By way of introduction, I'm wearing two hats today. I am Chief Market Strategist for F.L.Putnam, and today I'm also moderating today's panel, and I'm joined by two of my wonderful colleagues, Tom Fay, who is the head of our private client group, and he's managed tax-sensitive portfolios for clients for over 30 years. He won't tell me the exact number, but he said over 30. And Susan John, founder of Financial Focus, nationally renowned expert in financial planning, former head of the CFP board, and a general joy to have on our team. So Tom and Susan are going to provide most of the content today with respect to capital gains. A couple housekeeping points that I wanted to make before we dig right in. First of all, the webinar is being recorded and will be available on YouTube afterward. If you want to ask a question, please put it into the Q&A box of the webinar. The chat has been disabled, so please put your questions into Q&A. We'll get to as many questions as we can. And at the end, we will have a survey, very brief, and we would really appreciate it if you would take some time to fill that out because it helps us to create better content for you. It helps us to let us know what we're doing well and what you'd like to see going forward. So with that, we will jump right in. In terms of what this is about, a lot of clients have asked us about capital gains this year. And as we have been managing portfolios, we're looking at that too. And as we talk amongst the investment team and the planning team about client capital gains, we see three risks that the prominence of capital gains this year is really highlighting for our clients' portfolios. The first is the risk of a market regime changing, and I will talk about that briefly. Second risk is the risk of holding a concentrated portfolio. In other words, a portfolio in which a couple, three names have grown to be really large positions because of market action. And then finally, the risk of short-term tax focus at the potential expense of long-term tax optimization. In other words, the risk that tax year anxiety this year drives behavior that might not be advantageous over a longer time frame. So that's what we're going to talk about today. First, I'll do a quick market update. If we look at the next slide, what you can see is that the economy is strong. The S&P 500 is up over 10% year to date, and it's up over 115% from the bottom in 2022, just 4 years ago. So what this means is that a lot of clients have very concentrated positions and a lot of capital gains embedded in their portfolios. The US economy remains resilient. I'll go through a couple slides on GDP and earnings growth. Unemployment is still very low. Artificial intelligence spending is still very strong. Corporate profit growth is still very strong. And so as we look at this, our conclusion is we don't think this problem, if you can call it that, will go away anytime soon because there are a lot of supportive factors for the equity market. So if we look at the next slide, you can see how GDP in the US is still much better than in other regions of the world. The dark blue line shows US GDP and how it's evolved over the last several quarters. And even though estimates have come down since the conflict began with Iran, we're still looking at 2.1% GDP growth this year, which is pretty strong. And you can see it's much higher than Europe, which is in green, or Japan, which is in red. So yes, the US GDP is growing more slowly than we thought, say 4 months ago, but it still looks fairly strong for this year. If you look at the next slide, what you can see are that estimates are still increasing. This shows 2025, 26, 27, and 28 earnings estimates for the S&P 500 and how those have evolved over the last several quarters. And again, you can see that estimates keep going up. So we really don't see a slowdown in the corporate profit growth or in earnings estimate revisions. And so again, as we look at solid GDP and earnings growth, we think that these embedded unrealized gains are maybe not going to go away anytime soon. And yet we know that capital gains realization this year is higher than it has been in past years. And if the market plays out the way it could over the second half of the year, it could get even bigger. So the last thing I wanted to cover is looking at how sectors have changed over time. As I mentioned, the risk of a regime change is real. This is a performance quote that's a little bit different from the ones that you might have seen in the past. What it shows is for 5-year periods, what sector in the US S&P 500 performance has been with the best sector at the top, best performing sector during that time frame, and the worst performing sector at the bottom. And what you can see, first of all, surprisingly, between 2021 and 2025, energy was actually the best performing sector, edging out technology. So that's interesting, a little bit unexpected, perhaps. But what you can also see is that over the prior 5-year period, energy was the worst performer. And healthcare was the best performer in the early 2010s period, and then was kind of middle of the road in the subsequent 5-year period and pretty poor in the most recent 5-year period. So these regimes can change over time. And you can see that the sectors that have done well recently aren't necessarily the ones that are going to do the best over the next several years. So just keep that in mind. It's always helpful, I think, to zoom out and look at longer term trends rather than what simply has worked so well this year and in recent years. So that's my market strategist hat backdrop to say the economy looks pretty good. Earnings estimates are still growing. And because of that, we don't really see the capital gains embedded unrealized disappearing this year. And so therefore, I think we and clients have to deal with that reality in portfolios. So Tom, can you talk a little bit about why capital gains are more of an issue this year than they've been in the past years?
Great. Thanks, Ellen, and welcome everyone. Your quote chart was really interesting because a lot of what it showed were the later years numbers significantly large, right? One of the challenges with capital gains this year is that we've seen market move dramatically higher over the last few years. As a matter of fact, over the last 3 years, the market's up almost 80% or more than 20% per year. And while that looks a lot higher than historical averages, when you look under the surface, it's even more pronounced. So what we've seen is several names, technology, artificial intelligence names, are not only tracking the market, but they're actually exceeding by a huge amount. A couple examples would be NVIDIA is up almost 900%. Broadcom is up more than 800%. Google is up more than 200%. So as a result, we've got a market that has really skewed to those large names that have had significantly higher performance than a growing market. So the real issue that has come about is that concentration has grown dramatically. And as a matter of fact, the top 10 stocks in the S&P 500 index, or the broad index, right now represent more than 40% of the index. That level is more concentrated than we've seen almost since the index was in place. What's more, the technology sector itself is up over 40% as well. Historically, when you look back in time, you very rarely see or don't see conditions where those extreme leaders that take form stay in that leadership role going forward. So what we really see is that concern that overall, many of the stocks that had done well would, the exhibit that just came up, for example, what I did was look at the top stocks in the market index in each of the last 5 decades, going back to 1980. And if you look at the exhibit, you'll see names that you really recognize. A lot of these stocks were considered one decision stocks, right? They were ones that you bought, held, and never really sold. And as a result, those capital gains were viewed as something that you never had to deal with. The old Nifty 50 coming out of the 70s and 80s, you saw names like IBM, Exxon, General Electric, General Motors that dominated the index overall. And if you look at that chart in 1980, you actually see in the top 10 holdings several energy companies: Exxon, Mobil, Amoco, Chevron, Gulf. so that was a decade that was dominated by energy. If you move forward to 1990, you had the age of the consumer that came in. So names like Walmart, AT&T, Bristol Myers Squibb, Philip Morris started to dominate the index. As you move forward again into the internet age, you saw a lot of companies that now took on leadership roles, such as Cisco Systems, Intel, AOL. These were names that at the time were trading at huge multiples, almost unheard of multiples, but they were the new dominant companies in an industry that would never lag again. And the reality was the internet changed the world, but the names of the internet holders weren't necessarily those that led forward. And if you look to the last column in 2020, where we kind of the decade that we're in now, you see Apple, Microsoft, Amazon, Google, Meta. Those are the names of the Magnificent Seven that have done so well, but they're also names that have created outsized positions and really represent that bulk of that 40% weighting that I mentioned earlier overall.
Tom, can you you mentioned that the top 10 names are 40%. If we go to the next slide, do you have some numbers on just how different that is from prior
Yeah,
eras which were also concentrated?
if you look at this, this is really dramatic. And if you look at the slide, so this is 10-year increments at the end of the year and the top 10 names and the percentage of the overall index that they represented. Obviously, what you're drawn to the far right-hand side, which is today at the index over 40%. But if you look at past peak periods where indices grew to high level, December 2000, that was the peak of the internet. And then after that period, if you look at the next 3 decades, the largest holdings really shrank dramatically relative to the last set of groups. If you look from the last 10 years, I mentioned the last 10 years, index averages are more than 15% per year, but you can see the dominance of the largest holdings. So they went from an average of 18% in 2015 or under 18%, all the way up to 41%. So significant risk associated with the market overall. And some of those names that were always considered to do well are the ones that have fallen the greatest. And I showed you a chart of a lot of those names that were there, but you don't have to look that far back to look at some of the names to just give you an example that are Lucent, WorldCom, AOL. These are companies that don't even exist anymore. So not only did they lose their leadership position, but they lost all of their market value as well.
I think you mentioned GE as one of the names. How is that done? That was a great stock for a really long time.
Yeah, if you flip to the next chart, and if you look at this yo-yo of GE returns, so I mentioned the Nifty 50, GE was considered one of them. And under the realm of Jack Welch, it was considered a top tier company that really could do nothing wrong. If you look at the chart from 1995 to 2000, it outperformed the S&P 500 index by more than 400%. But from 2000 to 2008, the stock was down 41% when the overall market was down less than 3%. The next decade, it tracked along with the market, which was really solid. But from 2018 to now, it's lagged by more than 50%. So think of a stock like this that if you wanted to hold through the entire period, so much of your success or failure would be dictated by when you owned the stock. And Susan's going to talk about that connection between investments and planning. But when you get single stock concentration, one of the big risks is that volatility increases dramatically. As a matter of fact, single stock volatility is more than 3 times a diversified portfolio. And all it takes is one of those leaders to fall out that can really impair your planning goals and your success. So, for example, just to give you the math, a stock that drops 50% needs to have a rebound of 100% to break even. So it's not an even sum game because of the way that the math works. a lot of wealthy portfolios are managed in a well-diversified manner just because they're not looking to chase after those largest returns. They're looking to grow portfolios consistently over time to avoid that significant drawdown risk that you would see in a concentrated portfolio. So what does it mean overall, right? I mean, giving you a lot of numbers. One is that performance of dominant players tends to not last forever. Secondly, concentrated portfolios that grow out of significant outperformance actually have volatility that are multi higher than a diversified portfolio overall. And then lastly, one of the things to think about is for many clients that may have a managed portfolio of individual companies, but also may own funds in their 401k or retirement accounts, they may be even more concentrated than they think because they think they're in well-diversified indices that, quite honestly, now have highly concentrated positions that are far above what the average is over a long period of time. So the message that we really bring to you is you really should be talking with your advisor, analyzing your portfolio, looking not at only at returns and at individual companies that have done well, but examining how do you improve the risk management of the portfolio, which may very well be taking gains, reducing concentrated positions, and broadening diversification.
So, Tom, I think you've convinced us that we need to recognize some capital gains. Susan, can you talk a little bit about tax brackets and, how significant is this capital gains tax and how do you think about it over the course of a client's lifetime?
Susan,
Susan,
you're
I think you're muted.
Sorry.
There we go.
One of the great things about working in our teams at F.L.Putnam is that every client gets someone who's looking very carefully at their portfolio and somebody that's looking at the longer term for them. So we try very hard to manage the risks that are going to give you the best of today as well as setting you up for a better tomorrow. So I thought it might be just a good idea to take a look at our tax brackets today and think about the fact that in 1986, that was the last significant, really significant tax act change when Ronald Reagan brought in tax reform and dropped the top rate from 50 down to 35. And there actually were really only two tax rates at that time. Since then, there have been 9 significant changes, always adding a slightly higher bracket and adjusting somewhat the amounts of money that are fit in there. Plus, we have a little annual addition for inflation that helps us avoid bracket creep. So the bracket is a range of income taxes at a specific rate, and we, regardless of our income, small or large, we all fall into a number of different brackets. So we get advantage of the 10% bracket, the 0, the 24, all the way up to the 37. And a marginal bracket is the rate that you're going to pay on the next dollar of income. But it's not just the ordinary income that we're looking at. We also have capital gains tax brackets. And for those of us that are on Medicare, we have a good friend called IRMA, and we're going to talk a little bit about IRMA as well. So I think we have some slides that will show us a couple of examples here. Al and Sophie are still working. They make fine income. Al's going to retire this year. Sophie is going to stay on a little bit longer. Al is thinking of collecting Social Security next year, but we'll talk about that. He's only 65. Sylvia's 62, and she's going to stay working for a little while longer. George and Gracie are retired. They have their primary source of income is their requirement distributions, and you can see that George and Gracie have a larger proportion of their total net worth in their retirement funds. And then just for fun, I thought we'd ought to look and see what happens when Gracie is the survivor all by herself. So generally speaking, we kind of look at 5% as a capital gains budget, and it can be, sorry, I don't know what that was. I'm having something outside here at the moment. It's not bike week, but I think they're coming to Wolfboro anyway. Sorry about that. We think about capital gains as kind of an average budget, capital gains being 5% of what the value of the portfolio is. And in a given year, it could be more or less than that. We can also do a little planning when we know that there's going to be a significant event that's going to cause you additional income, and try to adjust that budget so that it works for you in that way. So Al and Sophie have employment income. Their taxable income is a little over $1 million. Their investment income is 136.5. They are not pulling anything from that. They are investing all of that. Their capital gains is 5% of their taxable portfolio, and they have a little bit of tax exempt income. They're going to pay ordinary income tax of $84,000, $126,000 of capital gains. They're also going to pay Social Security and Medicare tax on Sophie's earnings. They're going to pay net investment income tax because they're in a higher bracket. They're going to pay an additional Medicare tax on Sophie's earnings, and they're going to have a little IRMA on Al's Medicare. George and Gracie, on the other hand, have a total income, a taxable income of $683,000. They've got investment income of $18,000, and they spend that. They've got capital gains of $275,000 in their taxable portfolio. They have tax exempt income of $82,000, which is really great for them. They have Social Security of $45,000 and a whopping retirement distribution of $380,000. So they are going to pay about the same amount in ordinary income tax, and that's a factor of the retirement distributions, the Social Security, and some of their investment income. They're going to pay the net investment income tax because they're high earners, and they're going to pay IRMA, of course, on their Medicare as well. Gracie, as a survivor, is going to have exactly the same income, except a little less Social Security as when George was alive. But Gracie is going to pay a lot more tax. She's going to now be on a single table rather than on the joint filing table. We often call this the widow's penalty, and we're getting more and more questions about this in planning all the time. But if you look at the tax as the percent of total income, total taxable income, you see that Gracie is actually paying a bit more on a bit less, the red figures there. We can go to the next slide. We can see how this works in the black brackets. So the low bracket is 10% bracket with 12, 22, 24, 32, 35, and 37. The 24 and the 32 brackets for married filing jointly are pretty big brackets, and a lot of clients fall into that, even on the low end. On the single side, you can see that they ratchet up a lot faster as far as the income is concerned. So in the case of Al and Sophie and everybody else, they pay some at the 10% bracket, a little more at 12%, and so on all the way up. So if Al and Sophie wanted to reduce from the 32 bracket to the 24, they wouldn't have too far to go. But on the other hand, Gracie in the single bracket would have to take a pretty large reduction in income in order to get down to the 24 bracket. That's only significant because of the huge retirement distribution that Gracie's going to have to take at the single bracket. So, people get really worked up about their tax level, and you can think about it in a different way. So on the first slide, Al and Sophie are taking home $531,000. That's their income that they budget for their spending. Out of that, they're paying almost $280,000 in tax, which is about 52% of what their budget is. George and Gracie, on the other hand, have about the same amount that goes into their spending. Their total tax is $158,000, slightly less. So it's only 30% of what they're bringing, of what their spending budget is. Gracie's in a little different situation, again, paying more than when she and George were together. Let's take a look at the next slide. The insidious thing about IRMA is that once you're in a bracket by even $1, it's not a 10% and then a 12% bracket. You're in the whole bracket. The other thing that's hard to remember is you earned the income in 2025. You reported it to the IRS in 2026. And now in 2027, you're going to get hit with these additional monthly amount. So income related monthly adjustment amount, that's IRMA. And more of us are getting to know IRMA all the time.
So we've talked a lot about what the different tax brackets are and how this changes over time and how you might want to recognize gains or pay taxes early, depending on what your situation is going to be like later in life, just because everything changes. But Tom, what can we actually do to address the capital gains that so many of our clients have embedded in their portfolios? Tom, you're muted.
Sorry, I did that when Susan was mentioning noise. There are a lot of strategies that you actually can employ. Obviously, the first one, trimming oversized position and paying taxes, is one. And it is something that we recommend that clients think about. So many clients think about their taxes separate from their investment gains and say, well, I want to maintain the same level of taxes so I can do planning. And the reality is, with the markets at a significantly higher level, it makes sense that they would be incurring more gains consistent with the gains on the portfolio. So trimming positions is one. Managing across portfolios. So for many clients, they have a taxable portfolio or trust. They have a tax deferred portfolio with an IRA or rollover. They have a Roth account, which is a tax exempt account. And as you look at concentration, you may have that in one of your portfolios, but if you can diversify so that the others provide that balance, you may be able to provide overall portfolio diversification across those accounts. So that's something to think about. A big one that many of our clients use is philanthropy. So gifts and gifting with securities, especially highly appreciated securities, is a great way to not only to contribute to organizations that you have a value that you want to support, but also that tax cost goes with you, and the organization incurs no additional issue, and you actually remove the tax cost from your overall wealth situation. You may want to give beneficiaries in a lower bracket securities, and that if they sell, they would be able to realize. So you want to just be careful here to not incur kiddie tax. There's rules associated with that. But we mentioned IRMA, right? So when Susan mentioned IRMA, well, IRMA exists for retirees. It doesn't exist for 40-year-olds. So that capital gains realization may have one impact on a child that it doesn't have on a parent, and that you would be able to look at the evaluation on what makes the most sense. There are a lot of other strategies, including tax loss harvesting, that we work with clients on. So as individual stocks may incur a loss during the course of the year, you can actually sell that holding, and as long as you don't replace it within 31 days, you can get the benefit of that tax loss. There are more complex strategies that are available. Direct indexing, which is another way to harvest losses. Long short strategies, where you can employ strategies to create losses that you can offset gains overall option writing strategies. So the answer is there's no one right or wrong strategy. I think that there are several that you can use. And again, the message really is to work closely with your advisor to examine what's in the best interest for you and what would work best for you and your family overall.
You know, the urge to save taxes now is so compelling, but we have to be mindful of how that sets us up for the future as well. Did you know that there's $48 trillion in retirement funds? What a treasure trove for the IRS. And I think many of our clients, when we're doing retirement planning, are amazed to see how much their required minimum distributions are actually going to be. And as we looked at Gracie, we could see that she was going to have a gigantic retirement distribution once George was gone. And while the living expenses for Gracie might be considerably less than they were for the couple. So we have some pretty sophisticated tax planning software, and we like to urge clients to contact us towards the end of the third quarter or into the fourth quarter, once we have a better idea of what their overall tax situation is, to see if there are any opportunities to reposition things so that they have a better result going forward.
Susan, one of the things that you really highlighted is how people's tax situation changes over time, and it's not really set it and forget it from a planning perspective. It's very much trying to minimize taxes over the course of a lifetime rather than just minimize tax this year, which might have negative repercussions in future years. How do you help people develop a savings plan in terms of identifying what type of accounts they should be putting money into?
Sure, I think we have a slide for that. Um, when we're talking to younger clients, you know, they get their first job and they're all excited they've got a retirement plan, and they want to go right away and put as much as they can in the retirement plan. But the truth is they're probably going to need some of those funds before they're available without penalty at 59 and a half. And so while I would urge them to contribute the maximum to get the employer match, they also need to build, first and foremost, an emergency fund. It's also amazing to me how many older people don't have an emergency fund. So I think that that's something that we really need to do. It should be pretty liquid. It can be certificates of deposit. It could be treasuries. It could be a money market fund, but at least have 6 months or some extraordinary expense that you can look out and see that you're going to have in the future, whether that's a new car, a new roof, or a new baby. Then after that, you want to develop your taxable accounts and Roths, if that's available to you, especially younger people, putting as much as you can in a Roth IRA after you develop your emergency fund is really a great idea. It's never going to be taxable. Who knows how long that vehicle is going to be around? So take full advantage of that. And then again, tax deferred, save some money on the higher part of your income and get the match from your employer. Pretty much a simple general rule, but that's kind of the way we look at it.
And then when you're taking money out, how do you help to minimize taxes on that front?
Well, that's a little bit too, but again, there's a general rule, I think, on the next slide. You've got your required minimum distribution if you're of that age, which if you were born in 1958 or earlier, the age is now 73. If you were born in 1960, the age is 75. If you were born in 1959, there's a bit of a problem because they haven't decided yet whether you need to be taking it at age 73 or age 75. So that's a bit of a problem. But you can also reduce the amount of taxable income by doing qualified charitable distributions, and we can talk a little bit more about that. Next, Social Security for most people is 85% taxable at ordinary income rates. So that would be the second spending bucket. And then taxable interest in non-qualified dividends. Those again are taxed at the higher ordinary income rate. If you have trust income, the distributable net income from trusts, that comes in two packages. It can be ordinary income, or it can be gains or qualified dividends. And then capital gains, which are typically at a lower rate, or if you don't need to spend those, reinvest them. And finally, tax exempt income. But again, it all depends on your situation. But this is the order that we suggest doing. Spend the high tax dollars first unless you can reduce them.
So there's a lot going on here. Social Security, RMDs, Roths,
Yeah.
taxable accounts. What do I do when?
Well, there are some opportunities in here. So you can start taking Social Security at age 62. Unless you decide you're not going to take advantage of that, which you can say, I don't want it. I don't know too many people that want to do that. Then you must begin taking it at age 70. At age 59 and a half, you can, if your plan allows it, take in-service distributions from your 401k without a penalty. They will be taxed, but maybe you're in a lower bracket if you've decided to ratchet back or you're not taking Social Security yet. The advantage of doing that is you can roll that over into an IRA, or you can do a Roth conversion with it. And if you're not taking Social Security yet, there's an opportunity to do that. At 70 and a half, this is for people that have those really, really large retirement balances that would like to whittle them down and have some charitable desires. At age 70 and a half and on, you can make a qualified charitable distribution outside of your required minimum distribution of up to $100,000. So it comes out of your IRA. Doesn't work in qualified plans. It needs to be in an IRA. Comes out of your IRA, goes directly to a charity. Can't be a donor advised fund. It has to be a 501c3 organization, actually, and not a penny of that goes to your income. So you get to accomplish some charitable goals and reduce your tax for the future with a substantial gift. You can do a Roth conversion anytime, and we often suggest that people do that. Again, looking at tax planning during the fourth quarter of the year, try to max out the current bracket that you're in and stay below the next IRMA bracket if you're taking Medicare.
So Susan, you mentioned that the last major tax act was during the Reagan years, and taxes went down and then have crept up a little bit since then. What is the outlook for taxes going forward? Are clients better off paying taxes now, with the idea that rates might go up, or do we think rates might go down and therefore they should put off taking capital gains?
Well, that's really a judgment call, but I just look at where we are tax-wise now and really considering our economy and everything else, our tax rates are pretty low as they have been historically. There are also some advantages for people in lower tax brackets. There is the $6,000 per person bonus if you qualify for that. You don't need to be taking Social Security in order to get that bonus. You just need to be under a certain level of wage and you need to be over age 65. So there are some advantages for people there. There are some other advantages as well for people in lower income brackets that would allow them to take some capital gains and still take advantage of those savings. We always look for other methods to save for money that's going to be either tax-free or tax-deferred. We still recommend 529 plans for people for saving for education and medical savings accounts. Those are a great idea. If you can save those, and if you can save them for a medical emergency rather than spending them annually, you can build up quite a nice tax-free portfolio there as well. So there are a lot of different ways to do it. It takes a little forethought and planning, and of course, everybody's situation is a little different, which makes my career as a financial planner quite exciting.
So we have a number of questions that have come in, but before I get to those, Susan or or Tom, do you have any kind of final thoughts on general advice you can provide for people who are still saving for retirement? What's the big picture takeaway?
So I have one, and that is, as you think of investment returns and taxes, don't think of them as two segregated issues, right? They really are your net returns on portfolios, and recognize that capital gains and paying taxes is part of building a successful portfolio going forward. And, this is, my father used to always say, I never mind paying taxes because that means you earn something, and recognize markets have done spectacularly well. We want to make sure that you're not in a position where your portfolio is at significantly higher risk. And now's the time to be looking carefully at that, to broaden diversification, to pare back outsized positions, but also recognize that paying a little taxes now is really going to benefit you. And studies have shown that well-diversified portfolios, even after paying taxes, tend to outperform highly concentrated portfolios that have significantly higher volatility.
The other thing I would say is that the advantage of doing tax planning is that you're not going to get a surprise. It's not like your CPA calls you up and says, "Oh my gosh, you got to come up with another $50,000." With tax planning, you're going to know ahead of time that you've got a big amount that you're going to have to pay, and you realize why you did that. Why you're paying that larger amount of tax.
So we have a number of questions that have come in. The first one, I think I'll ask Susan and Tom both. I guess Susan can answer it first. The question is, with the ability to pay zero commission on trades, can't I just consider the investment account an emergency fund since it's pretty liquid? So why do I have to have a separate emergency fund? So maybe Susan, you could take that first, and then Tom, you could take that.
Well, definitely it's liquid. But if you've had any appreciation in your account, you're going to pay capital gains to free up that money. So, if you're trying to avoid doing that for an emergency so that you can use it to reposition an asset, it would be more advantageous to have something like a money market.
Yeah, and I would just add that you can have that inside your investment portfolio, right? So Susan's concept of emergency thinking and the segregation of funds for that are highly liquid, that aren't going to cost money in terms of taxes, makes a lot of sense. But when managing money for a lot of clients, we're looking at the overall asset allocation. Then that asset allocation involves equities, which are growth but highly volatile, fixed income, which are income oriented but less volatile, liquid securities like money markets that are date dollar in, dollar out, as well as alternative investments. And I think the planning is really important to think that through, but you might want to think that through in the context of your overall investment strategy. And it may very well be that emergency provision that Susan referred to is inside of a managed account, but with the same characteristics and the size that she referred to earlier.
Yeah, and as a matter of fact, we have a number of clients that have a little larger, what we call cash or short-term funds, as part of their asset allocation specifically for that reason.
So here's a question for Susan. What steps can one take to plan for the widow's tax?
Oh, that's a good one. We have a number of people who are looking now at how their beneficiary designation might be different depending upon your situation. You certainly want to leave enough for your surviving spouse, but the other tax change that we had, which is a really insidious one, is for required minimum distribution. So the surviving spouse, and a qualified beneficiary who usually is a person that's a special needs person, get the stretch. The rest of retirement fund inheritors need to take required minimum distributions based on their own age, but drain the accounts by the 10th year following the death of the account owner. Despite that, some people are doing planning by passing assets to children or grandchildren through retirement plan distribution planning, where they know their spouse is not going to need $8 million of 401k. This is really for people that have large retirement portfolios to look at the rest of your assets and see if you can deploy some of those in a way to further generations that would be more beneficial. We also remember that retirement plan assets in states that have estate tax, like Maine and Massachusetts, those assets are counted. So not only do you owe the whole tax on it, but you may owe estate tax on it as well. So that's a gigantic tax bite. So really some planning around retirement beneficiaries is probably a good way to deal with that, or to begin to deal with it.
Here's a question for Susan. Does a contribution to someone's child education account reduce the RMD from an IRA?
No, it does not.
Okay. Here is a question that I think either of you could take. Maybe I guess I'll ask Tom first. Shouldn't I just hold the appreciated stock until I die and allow my heirs to benefit from a step up?
I think a lot of that is a function of how old you are and health wise. So you can do that. Again, the real challenge with it is that is that stock going to be worth as much at the time of your passing and the tax benefit over time. So that's the concentration risk that I talked about. That's the higher volatility that's associated with single stock risk. And again, in a little bit of a way, that's the tax wagging the tail dog, right? So I do think for many clients, especially elderly clients, that is something we look at. I mentioned one of the choices we had was to diversify across types of accounts. And Susan talked a lot about retirement accounts that are significant. So you may be able to hold that taxable stock and then not have it inside of your managed account so that you're not mirroring your portfolios that are of different tax strategies, but that you're complementing them. And in that case, that works. But I think the big challenge is if you're younger and have a long runway before you're likely to pass, that strategy of just holding appreciated stock is a big risk for downside volatility in the stock and the loss of the benefit that the heir will receive.
Yeah, I really can't add anything to that. I think that's right on, Tom. And, it's interesting where we see that parents or grandparents give stock to their younger children rather than cash. Some of those stocks grow pretty high before they liquidate them. It's a lot more difficult for them to sell a stock than it is to to liquidate some cash. So those kinds of gifts tend to get kept, and they do develop some capital gains over time.
Here's a question for Susan. Are the IRMA increases permanent once they are incurred? In other words, if I have a big gain year, will that increase my Medicare premium forever?
No, it's reevaluated every year. So whatever your tax situation is, 2 years later, you're going to have the IRMA effect. You can actually protest or ask for a waiver if you have an event that's like a one-time event that's going to really boost your income up. If you sold a home and you paid tax on that, that might be a residence. That might be something that would get you a waiver. If you have a lot of medical expenses and had to liquidate securities in order to cover them, so you have a lot of income, but not a deduction, an adequate deduction for that, that would be another circumstance where you could ask for a waiver. And I understand that they do that pretty quickly and reasonably.
A couple of questions have come in on the regime change and the change in the concentration of the S&P 500. So one question is, when you talk about possible regime change, what indicators do you look for when you feel they are going to fall off the leaderboard? And I think this could talk either about sectors or about individual companies. Tom, do you want to take a stab at that, and then maybe I can add on?
Yeah, I think so much of it is the the extreme condition that allowed that outsized sector and stock concentration changes. So, when energy prices were really high and those stocks did well, there's a natural thought that is energy prices always stay at that level. As soon as they came down, you saw a consequence associated with that. The internet craze was one where, quite honestly, we ended up in a bubble that you don't really see until it bursts. And so when you get stocks that are trading at absolutely unreasonable valuation and people start to change the rules on how to think about them, that's probably a time when you want to take some of that off the board. But I think the macro ideas are interest rates, economic growth, international versus domestic. There's a host of things that would promote a regime change. And to make the assumption that the stock that had done extraordinarily well is unique in the sense that it's not sensitive to those outside economic conditions is unreasonable. And to think that those conditions will stay the same going forward is probably unreasonable as well.
From a market strategy perspective and a portfolio manager perspective, we look at this all the time. I would say that the sectors and the stocks that tend to do well over a given time frame are doing well very simplistically. You can think of it this way for one or both of two reasons. One is that the earnings are growing, and the other is that the earnings multiple is expanding. And so if the earnings are still growing, then the stock or the sector is probably going to continue to perform pretty well. And certainly if you look at relative earnings growth, so how well are the earnings of that sector growing relative to the rest of the market? If that's holding up, then the sector probably continues to do pretty well. On the other hand, if it's all price to earnings multiple expansion and the earnings are stagnant or are not growing faster than the rest of the market, then you might see an opportunity for that stock to be relatively weaker. So we're looking at both the fundamentals. Is the market they're serving growing? Are their margins expanding? Is their cash flow conversion improving? Are they paying down debt? Are there reasons why their earnings are growing faster, or is that about to slow down? So that's the key part. And then the price that investors pay for those earnings or the multiples on those earnings are much more behaviorally driven. They're determined by the behavior of millions of market participants. And so you can try to observe patterns, you can try to predict how that will happen, but that's not quite as analytical a process as seeing what the earnings are doing. So we're looking at what is happening to the underlying drivers for those companies and sectors and asset classes, as well as simply how expensive are they?
Yeah, you make a great point. It's earnings, but it's expectation around future earnings. And that's where sometimes if you look back in history, the emotions really drive those stocks to prices that are above what that normal discounted cash flow at a proper risk level would be.
We have another question on the concentration, Tom, which is when the concentration of the top 10 declines over subsequent, say, 5 or 10 year periods, is it because those big 10 get relatively smaller or because the other 490 get bigger?
Yeah, I would say you would hope it would be the latter, but usually it's the former. So if you look back at historic times of peaks, I mentioned the energy sector that was outweighted. That was a condition where energy prices came down and a lot of those stocks fell dramatically. The internet bust was one where, in 1999, four stocks drove the 20% return on the index. Those stocks were down significantly. As a matter of fact, between 2000 and 2001, many of those top stocks fell between 48% and 70 to 90%, and a couple of them actually disappeared altogether. So what we would love to see is the market broaden around it and the others become stronger, but the concentration risk historically has provided weakness in those leaders at some point. And to your your answer on fundamentals, that's what you're watching, because you can just say, well, let's get out of them all right now. But quite honestly, the last few years, it's driven a bulk of those returns. And for those investors that walked away from them, they would have walked away from significant gains. So that's part of the challenge in terms of monitoring fundamentals, looking at the technical strengths of the stocks, but recognizing that they're likely not to be the great leaders forever, and be ready to take some gains and to look at regime change when it comes.
Tom, you also mentioned that for people that have most of their assets in exchange traded funds or mutual funds, it's worth a look under the covers now and then to see really what you're holding, because, as you said, you could be really surprised and have a couple of really large positions in there. And if those are in retirement plans, of course, it's much easier to unwind those. But if they're in taxable accounts, it's a lot more difficult. You've got your work cut out for you trying to do that.
So
Yeah,
we
that's
have
a
one.
really great
Sorry, go
point.
ahead, Tom.
No, I was just going to say Susan's point was an excellent one. And I think some mutual fund families, you might own several funds, but if you looked under the hood, all those funds actually own the same largest position. So your concentration is far greater than you think when you thought you were diversifying by owning multiple holdings.
We have one last question that's a pretty simple one. Does FLP or my portfolio manager have any incentive to turn stocks over or to make transactions or commissions?
Absolutely not. As a fiduciary, we're going to do what, and obligated by law to do what's in the best interest of clients. There is no benefit from transactions. Our goal is actually to optimize your portfolios, because that's how we get paid. And we'll do the right. We're never going to be 100% right. And if you've got an advisor that tells you they will be, I think you would worry about that advisor. But we work every day as part of a team to make sure that we're trying to optimize the best information we can in all client portfolios.
We love to hear from you. So if you have questions about that, just give us a call. If you're concerned about something in your portfolio, particularly talk to your investment advisor, or if you want to know what you might do to make things better for the future, talk to your financial planner.
So I think my takeaways from this are that capital gains taxes are actually a pretty small part of the overall tax picture for many clients, and particularly when looking over many years, there are a lot of levers that can be pulled to be smart about the order in which we save and spend money, which accounts we put which type of assets in, and that in a year like this, capital gains taxes might be appropriate, and maybe capital gains budgets are just going to have to be more flexible than they have been. But every case is different. Every person's specific situation and prospective situation is different. So definitely talk to your advisor and your financial planner about your tax situation if you have questions. I'd like to thank everybody for coming. Thank you, Tom and Susan and the whole team for helping us to put this together. Again, there is a survey. If you would fill it out, we would really appreciate it. If you do want to be contacted, you do have to put your name in the text box somewhere, because otherwise the survey is completely anonymous. So with that, I will thank you all for your time. Hope you have a wonderful day.
Thank you.
Thank you.